CRE CLOs stands for Commercial Real Estate Collateralized Loan Obligation. And these CRE CLOs are the capital behind bridge loans. And the way that that works is a lender makes a bunch of bridge loans, and then they slice and dice them, package them up, and then issue bonds, which are CLOs. And then you've got CLO investors who buy the bonds, and then the lender is trying to make a spread, right? Because of collateralizing these loans and cutting them up into A, B, C tranches, what have you. I don't know if they actually do C. I don't think they do. They can sell those bonds at tighter spreads. And then they basically lend out the money at a bigger interest rate, and then they pocket the difference. So that's how bridge lenders or debt funds make their money. And like I said, this loan product in this structure is only for bridge loans, which is why it makes sense that about half of them are in distress because, yeah, if you are a part of a bridge loan deal that occurred over the last 3 years, it's most likely a problem, unless it was, I would say, within the last year or so, maybe the last year and a half, honestly. So it's all starting to happen from kind of the 2021, early 22 time where things were out of control and things were over levered on the basis of uber low interest rates, and that those interest rates were going to stay. And then, of course, they didn't, as we all know,
Or
and as
at
we've
least
covered.
not raised to the clip that they rose in that very condensed period of time, the quickest spike in interest rates in over 40 years.
Yeah. So it's been a whiplash, and it's been a tough situation for floating rate borrowers, not just for CRE CLOs, so not just bridge loans, because there's other floating rate loan products, for example, like agency floating rate loan products. But the difference with CLOs, of course, is because they're bridge loans, they're often most likely made at a higher leverage point, which only adds to the challenges and likely distress.